In this video, we will explore about the fundamental principles of business valuation, starting with the crucial distinction between what you pay and what you actually get. Let us begin by clearing up a common misconception. Many people use the words price and value as if they mean the same thing. But in the world of finance, they are very different. As the famous investor Seth Klarman explains, in capital markets, price is often set by the most panicked seller. It fluctuates wildly based on fear and greed. On the other hand, value is stable. Value is determined by the actual cash flows and assets of the business. Warren Buffett sums this up perfectly with the quote, "Price is what you pay and value is what you get." To understand this deeper, we can look at the nature of these two concepts side by side. Price represents the market reality. It is the number available from the stock market, known to all participants, and it simply represents what you pay to buy the asset. In contrast, value represents the analytical reality. It is not just given to you, it is based on specific evaluation and analysis. Value is specific to the valuer at a specific point in time, representing the true worth of what you get. Because value is based on analysis rather than a simple market tag, finding it is a mix of art and science, there is no precise formula that will throw out a specific number on an asset. Instead, we have an equation. We combine textbook knowledge plus practical experience plus professional judgment to arrive at a fair valuation. The reality is that uncertainty always exists in the inputs we use. Therefore, the final output is not a guaranteed fact, but an educated estimate contingent on our due diligence. Now, you might ask, why do we need to perform these valuations in the first place? The objectives can vary significantly. You might need a valuation for regulatory compliance, such as tax or accounting reasons. Perhaps you are looking at an equity swap restructuring, or maybe simply an internal value assessment for owners. It is also crucial for investment exercises, whether you are buying or selling a business, and for mergers and acquisitions. While the purpose varies from person to person, every scenario necessitates a formal relationship between price and value. The ultimate objective of this entire process is to look at a gauge and determine where an asset stands. We want to know if an asset is underpriced, fairly priced, or overpriced. The goal is to relate the market price to the intrinsic value. Since there are limitations in the process, valuers typically do not give just one number. Instead, we present multiple scenarios known as sensitivity analysis to show how the value changes if our primary variables change. So, where does this value actually come from? According to Warren Buffett, there are only two sources of value in a business: earnings and assets. Whether it is a business, a financial asset, or a real asset, value is generated through two streams. Stream 1 is periodic earnings, which is money you get while you hold the asset. Stream 2 is the final inflow, which is the money you receive from the sale of the asset. Let us see how these two streams appear across different asset classes. If you invest in bonds, your periodic stream consists of coupons and your final stream comes from redemption or sale. If you invest in equities or stocks, you receive dividends periodically and a one-time cash flow on sale. If you invest in real estate, you earn rental income and your final stream is the appreciated capital value. When we look at the reality of a business, especially from a lender's perspective, we must prioritize these streams. Think of this as a filter funnel. Priority 1 is cash flow generation. The primary purpose of a business is to generate cash flow to meet obligations via earnings. Priority 2 is the collateral or assets. This is only a fallback mechanism if the estimates fail. Lenders and owners agree that a business should run on cash flow, not by liquidating assets. There is a serious solvency warning you must always keep in mind regarding assets and liabilities. Picture a weighing scale. On one side, you have liabilities. These are fixed and must be settled in full. On the other side, you have assets. These are variable. The value of assets may be less than their balance sheet appearance. The warning here is that the capability of business assets to settle equity holders is always doubtful, whereas paying liabilities is mandatory. Now that we understand the sources of value, let us look at the three broad approaches to valuation. First, we have the cost-based approach, which represents the creator's view. Second, we have the cash flow based or intrinsic approach, which represents the investor's view. And third, we have the selling price based or relative approach, which represents the market's view. Let us explore the cost based valuation first. This involves valuing an asset based on the cost incurred to create it. It is essentially a decision of make versus buy. This approach is useful for strategic investors or engineers who can choose to build a factory from scratch. However, it has limitations. It is rarely used by financial investors because we generally cannot choose to simply build a massive company like a car manufacturer from scratch. We have to buy what is available. The second method is the cash flow based or intrinsic valuation. This is the gold standard for investors. Here, value is determined by what an investor is willing to pay today for the cash flows the asset will generate tomorrow. We calculate this by taking the future cash flows and discounting them back to the present value using a discount rate which represents our expected return. Intrinsic valuation can be further divided into two categories. The first is risk neutral. This involves adjusting cash flows by probability and discounting them at the risk-free rate. This is typically used by insurance companies. The second is the real world approach. This is standard for business valuation. Here we estimate the most likely cash flow and discount it at the risk-free rate plus a risk premium to account for the uncertainty. Finally, we have the selling price based or relative valuation. Under this approach, an asset is valued based on the price of similar assets in the market. We use ratios such as price to earnings, price to book, or EV to EBITDA. In the image, you can see houses priced at $450,000, $500,000 and $475,000. We use these comparables to value our asset. Since cost-based valuation is rare for financial investors, we focus mostly on these intrinsic and relative techniques.